We're back with Gary Wagner, editor of thegoldforecast.com, and we'll be talking about not just the technical aspects of gold, but a lot of other important issues that drive the gold price. Gary, welcome back to the show.
Thanks so much for having me, David.
Big news coming out of the gold market this week. Well, not really news, but the price itself makes the news. I always say that to the guests, especially yourself. Actually, I think you're the one who taught me this. The price makes the news. So 1742 was the latest price. Yeah, 1742 is the latest price that I'm looking at right now. This is the first time that you and I have spoken since gold has broken below $1,800 an ounce. And it is a dramatic move downwards. It is a very sharp move downwards, and it's caused concern for a lot of gold investors. So what can you tell us about this recent move? What caused this sell-off?
Well, the underlying forces causing the sell-off is the continued reaction to interest rate hikes by the Federal Reserve. It's not so much that they've raised rates incrementally and consistently over the last 3 FOMC meetings. It's the fact that they began with a 0.25% rate hike, 25 basis points in March, followed that up with a 50 basis point rate hike the following FOMC meeting. And then, of course, in June, they went to 75 basis points. And 75 basis points is a rate hike that is not that open, or it's not a rate hike that one would typically expect. It's rather large. And the fact that they most likely will raise interest rates by another 75 basis points at the FOMC meeting this month.
Okay. Now, you have previously told me that once gold reaches $2,000 an ounce, I believe it is, we're going to see a major bear market, major reversal. It doesn't look like we're going to hit $2,000 an ounce anytime soon, though, is it? Based on the current charts, would you say the momentum is stronger on the downside still? Or do we have any rays of light for the bulls here?
Well, right now we are firmly entrenched in a bear market. There's absolutely no denying that. The key about what many analysts have been looking at was the spiraling level of inflation. And the focus upon that is what drove gold to higher pricing. But it did top out very quickly because the real concern then became how the Federal Reserve is going to react to it and whether or not that will have a profound impact on levels of inflation. They've raised interest rates, but a lot of the inflationary pressures are sticky, persistent, and cannot be controlled by reducing demand. It's supply chain issues and bottlenecks, the war in Ukraine, and the effect that that has had on oil prices. And oil is such a critical component to all industries. If you're producing a product that doesn't require oil to manufacture, you've still got to ship it. So that's been the primary drivers of inflation. And the focus has absolutely shifted from inflationary pressures to the level of interest rates. And of course, higher interest rates has a very, very strong and bearish impact on gold pricing.
Speaking of interest rates, if you take a look at the yield curve, 10-year minus the 2-year, that's inverted. That's not good. Typically, an inverted yield curve leads a recession. So what's next?
Well, that is the common adage, so to speak. The way that I tend to look at an inverted yield curve is that it is a knee-jerk reaction to interest rate hikes that will tend to work themselves out of the system naturally over time.
Yeah.
A yield curve that is inverted for an extended period of time, in many cases historically has led to, or was followed by, a recession, I should say. So there's very good historical data to back that assumption. The question becomes whether or not the Federal Reserve can pull off lowering inflation and having a soft landing. And I'm on the side that that will be very difficult, if at all possible, for the Federal Reserve to continue to ratchet interest rates higher and not have a really profound effect on the economy. Up till now, it hasn't. The most recent jobs report today came in over the forecasts. I believe the forecasts were at around 250,000 jobs added last month. The number that came in was over 300,000. So it came in above expectations. The key to what we've seen in gold, more than anything else, or I would say as important as buying or selling pressure by traders, has been dollar strength or weakness. Recently, we've seen tremendous dollar strength. It's moved above a 20-year high. And of course, there's an exact inverse correlation between dollar strength and gold moving down. Or actually, the correlation is a positive. It's a 1-for-1 because gold here is paired and priced against dollars.
Yeah.
You will see that in other countries, for example, in Switzerland, when you look at it against Swiss currency, it has not had the same kind of sell-off that we've witnessed for those that look at gold and pair it against the dollar.
Now, this is an interesting piece of news that ties into the dollar. I'm just going to read the headline of this article dated June 24th. It says, Russia and China are bringing up a challenge to dollar dominance by creating a new reserve currency. First paragraph of this article by Markets Insider reads, Russia is ready to develop a new global reserve currency alongside China and other BRICS nations in a potential challenge to the dominance of the U.S. dollar. President Vladimir Putin signaled the new reserve currency will be based on a basket of currencies from the group's member countries, Brazil, Russia, India, China, and South Africa. It looks like a lot of countries, especially in the developing world, are trying to de-dollarize, and long-term analysts speculate that this could mean the end of dollar hegemony. Do you agree? And what does this mean for gold?
You know, I don't know what the final outcome will be. I can say this, that it's always been a desire of, especially Russia, and to a large extent China, to not have the US dollar as the primary standard for transactional events between central banks and large institutional hedge funds and things of that nature. The dollar has been the go-to currency ever since the end of World War II. And prior to that, because of the gold reserves that the United States had built up after Roosevelt's action back in the 30s of having citizens turn in their gold in exchange for fiat currencies. In other words, once we went onto a fiat currency, the dollar has been the go-to currency. Of course, that is what China and Russia would want to do more than anything, is not have it fixed to the dollar. In the case of Russia, we've boycotted dollar transactions after they went in and invaded Ukraine. So their business and their ability to transact international business has been severely hampered because of that. So to have the dollar lose its importance in terms of it being at the top of the heap, in terms of an international exchange, would benefit Russia, and it would benefit China, to some degree India. But China and Russia, it would definitely be, it's on the top of their wish list. Will they be successful in that? Only time will tell. But they, especially in the case of China, continues to get more powerful month by month, year by year. So inevitably, another currency might in fact challenge the US dollar, but I don't think that that's going to be on the radar relatively soon.
All right, so you see no immediate impact on the dollar for now from this piece of news, but all right, we'll keep tabs on that. I will come back to your dollar forecast and your gold price forecast towards the end of the interview, but for now, I want to talk about price spoofing. This is a piece of news that came out just today, actually, or yesterday, rather, from BNN Bloomberg. I'm just going to read the headline again. JPMorgan's big hitters of gold market face trial over spoofing. The former JPMorgan Chase & Co. managing director ran the bank's precious metals business for more than a decade, making hundreds of millions of dollars in profit trading everything from silver to palladium. Now he and two of his former colleagues face a federal jury in Chicago on criminal charges for thousands of so-called spoofing trades, which prosecutors say were used for years to generate illicit gains for JPMorgan and its top clients. This is referring to, of course, a CFTC ruling back in September 2020, and now they're actually going ahead with the prosecution. JPMorgan was fined $920 million for spoofing the precious metals markets. What's interesting is that it's not just one case of spoofing. It's thousands of trades over many years. So, we know they've been doing it. There's evidence of spoofing from at least JPMorgan. We don't know about the other banks for now. Maybe everyone's doing it, but we haven't. CFTC hasn't found everyone yet. But my question is, Gary, what does spoofing actually mean? Let's start by defining what spoofing is from a trader's perspective, and then we can talk about its impact on the gold market.
Well, what spoofing is when a huge hedge fund or institutional trader such as JPMorgan puts a exceedingly large buy or sell order into the market. In the case of a buy, well above the price range. In other words, they're putting a large order in that they'll pull it out before it's executed. And they'll use it to artificially drive pricing higher. And then they'll pull the order out because it has not been executed and initiate short positions. That is spoofing. In other words, artificially moving the market substantially higher on an intraday basis, up or down, and take advantage of that move that's an artificial move in terms of pricing.
Okay. Is that in itself illegal?
If the CFTC defines it as illegal, it is. I mean,
okay.
Obviously, there have been lawsuits. JPMorgan, what was it, a couple of years ago, acknowledged that and paid a fine. This is yet a new case. What it does show is that there have been systemic problems within the system that have allowed these large firms to literally go unchecked. In other words, this wasn't something that they did once or twice.
No, it's thousands of trades.
Systemic over time, over years. And as your article said, it's resulted in hundreds of millions of dollars in profit. So is it illegal? In my opinion, well, it's absolutely immoral. And I believe it is, in fact, illegal to put an order in that you are not intending or not hoping to have that order executed or filled. Okay.
Now, what market participants wonder, Gary, is whether or not this actually has material impact on the price of gold. It's not just gold they were doing it with, but let's just talk about gold for now. They were doing it to a lot of metals. So short-term and long-term impacts, what are they, if any?
Okay, the first thing, gold, platinum, and palladium are all markets that have seen this activity occur. The thinner the liquidity in a market, the easier it is to spoof because the quantity can be smaller and have a more dramatic impact or move pricing. The larger the liquidity or open interest within a commodity, the less effect a order will have. You have to have a larger quantity for it to have that same effect, to rise prices, say, intraday by 0.5% or 1%. On a short-term basis, it absolutely has a profound impact on the market. As a trader watching the market for 30 years plus, I've seen it occurred, but I didn't know what was occurring. In the eyes of a trader, what we see is all of a sudden there's a huge spike in pricing. And when we look through any kind of new fundamental event that might have shifted market sentiment that quickly, there's a void of information. And then the market settles down. The way I look at spoofing is short-term and has a defined and immediate impact. Long-term, it does not, because long-term, once they've made their move, it's a short-term move that they're looking to accomplish to make these profits. And over time, the market will go where it should go based on overall market sentiment of the group of traders and not a single trader or a couple of traders.
Okay.
Short-term, yes. Long-term, not so much.
Yeah, you'd have to do this on a basically minute by minute, every single day basis in order to sustain any sort of price, either suppression or elevation long-term, right? It's not very easy. That is correct.
And yeah, that is correct. And if you recall, there's a very large trader, George Soros, that was very involved in trading currencies. And there was a point in time in which he went eye to eye, or toe to toe, I should say, against the Bank of Japan. The Bank of Japan was trying to support the yen. Soros was shorting the yen. And his comments were that the Bank of Japan could do whatever they wanted to, and on a short-term basis, it would have an effect. It would be supportive for a short period of time, but that the yen would drop if the fundamental reasons that the yen was going lower continued to be prevalent in the market. In other words, it could not have a sustained effect, and even a government cannot artificially manipulate their currency over a long period of time, while they can have an effect on short-term strength or weakness within a given currency.
Okay. So can you just go back to the long-term impact one more time? So why is it that price suppression on a long-term basis is difficult to attain, Gary?
Well,
not just suppression. I mean, just manipulation in any direction. Suppression is just keeping it down. We can keep it elevated if we want, right? In theory.
Right. Well, the idea behind having a spoof trade is not a long-term scenario. They're looking to artificially prop up the market, where you see gold spike up $30 for no fundamental reason. The people initiating the spoof go in and sell the market at the top. And that, of course, will put selling pressure and bring it back into alignment. In terms of a long-term basis, the only example I can give of something of a commodity or a currency, which is a commodity in which an entity is trying to fix the price, support it for a long period of time, is a country, a central bank. And you'll see that when you have weaknesses. The example I gave you, when the Bank of Japan tried to maintain the Japanese yen at a certain level and it continued to drop. You will see something over time. An attempt can be made by a country, but not by individual traders. JPMorgan just isn't big enough. There is no single entity, because when you look at what the open interest is in any stock or commodity, the effect that even a large institutional trader such as JPMorgan will have over time will not work, because the pool of traders that are trading with the spoofer will naturally take gold pricing back to where it should be, based on real market sentiment and not an artificial move by a large order that's put in. Because realize, once that order is taken out, it changes the dynamics of the market, and it's taken out at the same point when the spoofer will sell into a market after they put a fake order in above current pricing, and then take it out as they initiate the short position. So by the nature of the technique, it's not going to be a long-term move in the market. So you'll see gold artificially spike up $30 or $40 and then come back into alignment, because once they take that buy order out of the market, or as price goes farther away from it, it becomes less likely. And to achieve profits on the artificial manipulation of moving the market higher, they've got to initiate a short at where they think the top of the range is going to be. And the large buy order has been taken out, and they're actively selling the market.
Okay. Well, Gary, you look at charts, every single day of your life. Do you ever see a particular price movement within, let's say, an hourly, or let's say even a daily basis, and think to yourself, this doesn't make a lot of sense? There's something fishy going on. Perhaps it's spoofing. Perhaps it's large trades, not several blocks of orders being placed that are irregular. Does that ever occur to you, Gary?
Well, I've seen it happen more than once. And really, you're never aware of it at that moment. You think, wow, this is strange. In other words, you see a intraday move where it's a tremendous spike. Within a 5-minute period, you'll see gold rise, say $30, $40. And then when you run through all of your different news services and wire services to see if there's a fundamental event that has shifted market sentiment, then you realize that it's incongruent with what you've seen in the market. In other words, if the Federal Reserve came out and made a statement that they're going to raise rates at the end of this month by 1% or 1.25%. And everybody is anticipating or baking in the high probability of a 75 basis point hike. That's not artificial, and that will be sustained because it will take a couple of days for this change in market sentiment to kind of work its way through the market. So what you typically see with a spoofing scenario is a very, very short-term move in a market. I've seen it, I don't know how many years ago, but it was during a holiday weekend in which it would be I remember one instance of spoofing occur on a Thanksgiving. Was it a Thanksgiving holiday? It was, in other words, where in the US markets were closed.
Right.
And the volume was very, very thin, even after they opened in Australia. And they took advantage of the thin volume in trading because of the holiday. And they could place a smaller order than they would in a normal trading environment to move the market in the direction they wanted it to go before putting on the opposite end of that trade.
You know, you'd imagine.
So we have seen.
Sorry, please continue. Sorry.
We have seen that occur. I personally have seen that occur on more than one occasion.
Yeah.
But you have no knowledge that it occurred till after the event. In other words, it's a move in the market that isn't backed by any fundamental, any change or dramatic fundamental event that wasn't present 10 minutes before the spike, let's say.
I was going to say, Gary, you'd imagine this to happen with a commodity or an asset that's not as liquid as gold. I mean, gold's last I checked, what, 11 to $14 trillion market, depending on the price of a given day. It's not a small commodity. I mean, you'd have to really put in a lot of trades to move the price.
It's the size of the spoofed order. In other words, you have open interest, and the definition of open interest is for every every contract that's a long and every contract that's a short, you have an open interest of 1. Then you have volume, and volume is the number of trades placed that day. And so with gold, typically it's over 100,000 per day, up to 250,000 contracts traded in a single day. That's contracts. So if you're putting in an order for 50,000 contracts, let's say, well above where the market is, that's an example of how you would create a spoofing scenario. It's an exceedingly large order in terms of the size of the order. And that's what kind of shakes the wheels up to make it spike higher, is it's got to be an exceedingly large order compared to daily volume.
Okay. Well,
which is why, and I'll leave it at that, which is why in something like palladium, which is a very thin market with very low liquidity. Yeah. In other words, the open interest is small and the number of contracts traded each day is small. It's easier to create that scenario than something like gold, and near impossible to do it in bonds because of the huge amount of open interest and volume. And that's why it occurs in the metals and not in the larger commodities such as debt instruments, US debt.
Yeah, that makes sense. Okay, moving on to some more other fundamental issues now. I know this is a trick question by design, but any particular black swan events that you're looking out for that may trigger major moves? I know you can't, by definition, predict a black swan. I think the question is more like, outlier events that you think could possibly happen, but have a low probability of happening, but could still be detrimental to the markets. In either way, maybe it'll be very bullish for gold.
Okay, and so again, can you repeat the question? In other words, what you're asking is
what is an outlier event that with a low probability of happening that could move the gold market dramatically in either direction?
Okay, I mean, there's examples. We had an inclination with the war in Ukraine, as Russia, for months prior to their invasion, had amassed hundreds of thousands. What was it at the peak? I think before the invasion was 150,000 troops, but it began with 20, then 50,000, and they kept building it up, saying that they were military exercises. Most analysts and even intelligent analysts in the US and Europe thought that the likelihood that they'd actually pull the trigger and attack a sovereign country was remote. And that's why when the invasion occurred, what was the 24th day of February, that was a black swan event. We saw it building up to the possibility of it happening, but most people doubted that it could happen. The other type of black swan event is when something hits the fan. An example of that is the banking crisis. It took a lot of people by surprise. And when I say people, I mean mainstream traders, that there was a systemic problem in the way mortgages were being written up and issued, and that there was a massive amount of bad debt that was bundled into these mortgage-backed securities. And so when that became news, that was the black swan event. But what led up to it wasn't really a high level of knowledge that lurked on the environment. So a black swan event by event is something that we're not calling to happen. We didn't foresee this occurrence happening, but does happen. In the case of the invasion by Russia, we saw signs of it, but most people didn't believe that they would have the stupidity or the guts. I think it's stupidity, but they went in for whatever reason they went in and they attacked Ukraine. And that was a black swan event. And meltdowns in the US equities markets that were a major day where it crashed, not where you had a defined period of time where you had a defined correction, but kind of where you saw it go down 5, 7%, 4% in a day, that come out of the blues. Those things are there. They do happen and they will always occur.
Okay, fair enough. And finally, I promised the audience we'd get your gold price forecast. So let's start with the dollar first, because you mentioned the dollar being a very strong indicator for where the price of gold is going to go. So DXY first, and then we'll go on to gold. Well,
I sent you a 2-month dollar chart that goes back to about 1985. And the reason I did that is at approximately 103, we did see a double top in the market, 2 occasions where dollar strength took it to 103 above and just shy of 104, it would then retrace and go into a corrective mode. And so on this third instance, which is this recent instance, it did exceed that level and broke back down below it, but only fractionally, and then moved above it. Once it broke really above 105, we got out of that territory, and now we're in a new price high for at least this decade or the last couple of decades. You've really got to go back a number of years before you actually see the dollar being that strong. The one period in time that we can look at, and this is, I believe it's around 2002, back into the 90s, is when it was rising, it rose above 120 on the dollar index. And then when we compare current pricing to historical data, what you see is there's only been a couple of occasions in which it went above that and then back below it, but going through that wasn't a substantial top. In other words, because the last time gold traded at a certain level, that is an important data set or fact that we need to be aware of. But it's, for example, the high of mid-2011 at 1920, that became a benchmark area because that was a new historical and all-time record high. So when it went past that, that became a major level of support. When it trades below it, a major level of resistance. There's certain areas that are just price points that it goes through, but you can't define it because of a top or a bottom in the market. And that's where the dollar is right now. The major top in the dollar occurs at about 120. We're sitting just above 107. What I have been looking at, because we haven't seen the dollar value be this strong in years and decades, and historically speaking, when we looked at when the dollar was last there, it was either there as market was rising or falling, and the top was well above that. It's not a major area of resistance based upon a historical top in the market. And because of that, you have to look at where that top is, and then you have to define how long it has taken since we have seen that to get an idea of the probability of it reaching 120 again. And then you have to look at the underlying fundamentals behind it. Right now, dollar strength has been a direct result of the Federal Reserve raising interest rates, because we had yields, real yields on 30, 10-year notes, 30-year bonds, basically at 0, 0.25%, 0.5%. They weren't bearing any kind of real yield, where they entertained a lot of people getting that as a fixed investment, or institutions putting that on as a fixed part of their portfolio.
Yeah.
Now that there's actually some yield in there, you get a lot of interest, and that interest is what has taken the yields on US debt instruments higher, and is what has attracted investors to go back into that pool and to look at that as a viable investment. Gold doesn't yield interest, and therefore there's an inverse relationship between rising rates and the price of gold.
Okay. Yeah, that makes sense. Gold is a non-interest-bearing asset, so it hedges against any interest-bearing asset that is impacted by inflation. So if real rates go up, gold tends to go down. Let's talk about then your gold price forecast. $2,000 gold. Is it going to happen next week, next month, next year?
No, the question right now is, how low will gold go before it finds support and either tracks sideways or bounces back to the upside? I've got a couple of numbers that I've been looking at. One of the numbers was 1720, and that was based on a series of lows that we've seen over the last 3 years. I believe that the market hit a low of approximately 1721 recently. And so that's a level that we're looking to see whether or not it holds. I think that there is not a tremendously high probability it will, but it could. It's an area we want to look at for potential support. However, if it breaks below that, my eye is on $1,680, which matches the low of the flash crash we had last year, where we saw gold sell off dramatically in one day and then actually close well above that low. The low was at 1680 and the closing price was around 1720. So it's another reason that those are important numbers to me. So the question is when we'll see 2000. I think it's going to be quite some time, but what I'm looking at is A, the realization we are in a bear market, and B, and most importantly, where could support come in and what would fundamentally need to happen for that support to come in? And what I mean by that is I'm a hybrid analyst, meaning I look at fundamentals to shape the direction, whether it's moving up or down of any given commodity. It's going to be fundamental events that shape the direction. The technical indicators tell me where that could conclude or where the places stop. So what needs to happen fundamentally? There needs to be a shift between market sentiment focusing upon rising rates and begin to focus upon exceedingly high levels of inflation. That is really the underlying fundamental events that need to occur before we see gold finding a bottom and beginning to move back up. What would do that? And the answer to that is rising rates amidst the point where inflation remains elevated. In other words, if in fact inflation is sticky and persistent, and if the systemic reason that we're looking at inflationary, and I'm talking about headline inflation, meaning including food and energy costs, are above 8%. And the Federal Reserve, let's say, raises rates to 2.5%, 3.5% by the end of the year, but inflation remains completely elevated. It doesn't have to go higher, but if it remains at the current level or it doesn't tick down that much, at some point there will be a basic shift in market sentiment in which they're not focusing upon rising rates, but high levels of inflation. And that's the fundamental change that has to occur before gold prices bottom.
Great. All right. Well, thank you for that analysis, Gary, and we'll follow up with you next time.
Thanks so much for having me.
Thank you for watching Kitco News. I'm David Lin.